Trading forex is a risky endeavor and not suitable for all investors. Hi, my name is Jay Norris, and I'm a 20-year trading floor veteran of the Chicago Board of Trade. I've written a couple of books on trading which were published by McGraw-Hill and which serve as the textbooks for our courses. And I'm the Director of Learning at Trading University. At the heart of what we teach at Trading University is understanding the fractal nature of markets so that we could take advantage of that design in our trading. Before we can demonstrate that to you, however, we need to define the term fractal. A fractal, the simple base component or model that when replicated becomes a much larger and more complex pattern, or a pattern or shape whose parts echo the whole, the study of which is called fractal geometry. A very important aspect of fractal geometry for us is scalability. Scalability for us means that price action on the higher time frames lends us guidance for trading those lower time frames, and what happens on those lower time frames in turn lends predictability for us on what occurs on those higher time frames, what occurs in the big picture. Let's give you an example of this today in the Australian US dollar market. Here's a weekly Aussie USD market, and we've drawn a fractal on there. Remember, the fractal is that simple base component or model that when replicated becomes a much larger and more complex design. Always best to remind ourselves of the simplicity of that. Take a very simple pattern, yet when it replicates itself, it can look very complicated. On the other hand, when we scale down that microscope, we see that it's really nothing but a lot of smaller patterns sewn together. Let's keep that in mind. We've designated the primary pattern here is up. We've designated this pattern on the chart as being up. Before we go any further, let's talk about that. Talk about categorizing patterns. It's very important for us. I promise we'll do this very quickly. For this study, we're going to include 4 different price patterns, and these are based loosely on Robert Ray's same designations in his book, The Dow Theory, with the exception of that micro pattern. Our goal in trading is going to be a simple one. We're going to look to trade when the majority of patterns are aligned. It's also very important that if we say we're able to identify and define the 4 patterns as being up or down, that we also know at what point those patterns shifted so that we can identify those times when it shifts again. This is very important to us as traders. Let's go back to the chart and we'll give you a lesson on that of how we would determine when a pattern has shifted. First of all, the easiest way to identify a pattern is the highs and lows on the chart. Here we have a pattern of higher low, higher low, higher low, higher highs also. So essentially we're looking at an up pattern overall. I'll show you a quick way to confirm that also, and that would be using a trend line. We're going to take the last 2 isolated lows, not the last isolated low. Take the last 2 isolated lows and we're going to connect those with the trend line. All it takes are 2 points to draw a trend line. The third confirms it. In this case, the trend line breaks. When we see the trend line break, we're going to go to the lowest point on that trend line, and then we're going to draw our retracement. And you can see where price bottomed right on that 50% retracement. That's pretty common, we know. We see this time and time again in markets where a normal trend, be it an uptrend or a downtrend, tends to find support between that 50 and 618 retracement level. So that's definitely considered normal for us. A healthy uptrend is going to correct. A healthy bull market is going to pull back. And we know from experience that those 50 to 618% retracements are pretty common. So let's go ahead and mark that 50% retracement on there to remind us that that is the support of our primary trend. Essentially, the market put in a double bottom on that 50%. So that's our primary pattern in place. We could see that pretty clearly. Let's drop down to a daily chart, and we're going to see what there is to see here. Remember that base component that we showed you, that fractal? Here, let me draw it again, because, again, we always want to remind ourselves to keep it simple. I know I need to constantly be reminding myself to keep it simple. There's that fractal pattern, and you might start to see that here. See it there, that A, B, C, and then we see the smaller ones, A, B, C. Here's another A, B, C. They're just overlapping each other. What I'm curious about is what happened right in here just prior to that market going into that very predictable pattern like that. Let's take a look at that. Once again, we'll show you those 4 patterns, and we'll give you a chance to write these down. Primary pattern, secondary pattern, day-to-day pattern, micro pattern. And we work with these, we teach these extensively at Trading University. So the day-to-day pattern, let's take a look at it here. Let's say we're right here, and how would we define that? Well, the primary pattern is still up, but let's take a look at that day-to-day pattern. Day-to-day pattern, which we're going to call it 1 week to 1 month, very definitely down, right? So 1 week to 1 month is down. So your day-to-day pattern is down at that point. Certainly your secondary pattern, which we're going to say would be 1 month to as many as 9 months. So the secondary pattern is down. We could see that. Let's mark that on the chart. Secondary pattern down. At the time, the day-to-day was down, right? This would be our day-to-day trend line. So when that day-to-day trend line got broken, that was significant for us. Now remember, we said if we're going to designate a pattern, then we need to go back in time and tell you when that pattern shifted, correct? Well, I showed you a pretty good hint when we drew the retracement on the weekly. How we know when a pattern is shifted is when it goes beyond this predictable zone. Draw that zone between 50% and 618, right? Once price goes beyond that zone, that between that 50 and 618, you have a pretty good idea that you have a new pattern evolving. That's a sign of strength, okay? What really is going to confirm it is if it gets through it, you have a correction, and then it goes on to make a higher high in this case. If it was a bear market, it'd be a lower low. In this case, you close twice above it, you correct, you come back, and you close above it again. Well, that's absolutely an indication that this pattern, that day-to-day pattern, has now shifted higher. Okay, so at this point right there, let's remove that frame. At that point right there, our day-to-day has shifted higher. Let's review that, how I can say that my day-to-day shifted higher. Take this trend, the day-to-day, the May move. Okay, our day-to-day pattern, we're going to call that 1 week to 1 month. So our day-to-day pattern clearly was down here. However, when that pattern, you get 2 closes above that zone, in this case the zone is created by the 50% and the 618, you get a couple of closes above that, that's an indication that the pattern's shifting. What's going to confirm that is if you do come back, you sell off, you come back and put in a higher high. So right here, we have a very good idea. Well, we know, based on the pattern, based on geometrics, that now the day-to-day pattern is higher right here because it closed beyond that zone. Now it gets interesting. Now let's go down to the 4-hour chart because we know right here, the beginning of July. Basically, once you take that high out right there, so the beginning of July, now we have the primary pattern up, the day-to-day pattern up, the secondary pattern down. Remember we said it's pretty simple. We're going to trade in the same directions as the majority of patterns. We're looking when the majority of patterns are aligned. Well, right here we can see 3 of those patterns, 2 of them are up. So when we have 2 of them up, that would be an indication that's the direction we want to be trading in. Let's drop down to the 4-hour chart now. At the beginning of July, because we did say at the beginning of July that we had the majority of patterns up. Here, let me bring in. Okay, there we go. Now we can see everything's right in front of us. The secondary down, primary up, with the day-to-day up. So I'm looking at 3 of these patterns. 2 of them are up, 1 is down. So you have the majority of them higher. Now, remember that micro pattern, that's pretty important to us. The micro patterns essentially are going to be these. There the micro's up, here the micro's down, here the micro's up, right? So what we're looking for, keep it very, very simple. If you have 2 patterns up and only 1 down, that micro pattern is going to be pretty influential because when the micro goes down, then you're going to have 2 down. When the micro goes up, you're 3 to 1. So when the micro's down, you're balanced. 2 patterns are down, 2 patterns are up. When the micro shifts up, then you have the majority of patterns are bullish. So that's what we're looking for. Now, let's show you how that works again, how we're going to measure the pattern. So currently we could see that here the micro would be up, correct? So that micro remains up as long as you're above that pattern. As long as you stay above that pattern zone there between the 50 and the 618. Now it could trade below it, but it can't, as long as it doesn't close below it twice, that pattern is holding. So what's happening is right here, the micro shifts in line. You have 3 patterns up, 1 down. So you have the majority of patterns up. These are the areas where you want to trade. Similar, we take that retracement And you can see here, it overran the zone. However, it can only close below it once in this case. So only one close below it. That's not going to cut it. This micro shift here, when that micro shifts here, once again, you have the majority of the patterns are higher because you have a micro shift in line with that day-to-day, in line with that primary. So very definitely the majority of the patterns up. This is where you want to be a buyer. Here you want to be a buyer. Here you want to be a buyer. It's another simple way of saying this. You're looking to buy dips in an uptrend. That's exactly what you're doing, right? If you look back at this pattern here, you can see you have clearly a pattern of higher lows, higher lows. Now, I'm going to tell you something. The news flow right here, when the news is coming out here, it's anything but good news. See how quickly the market sold off on these retracements? Very characteristic of corrections also. The news is going to be very bad here. It's the hardest thing for you going to be doing is taking this buy signal because there's going to be nothing but bad news in the headlines. So it looks so simple for us on the chart. On the other hand, it's anything but simple because I can nearly guarantee you when the markets are falling that hard, it's generally going to be on bad news. Now, remember we talked about scalability, that being a pretty important component for us also. Here, let's take a look at these lower down time frames right here. You can see we have some patterns drawn in there. Let's go back to those and we'll show you how those developed and how that can be pretty handy for you as a short-term trader. And again, we talked about that zone. Here, I'll show it to you. And I'll show you scalability. There you can see there's the zone between that 50 and 618. And you can see how that proved to be pretty good support there, correct? Well, again, it's going to be nothing but bad news when markets falling like a knife into that zone. So you definitely have to be aware that bad news for us is a good thing because it's knocking prices down and it's going to give us an opportunity to get in to buy a dip in an uptrend. Talking about scalability, you may see this zone right here that we draw and you say, well, where did that come from? And I'll tell you, well, it came from that low to that high. And you're going to say, well, that's fascinating, but how did you determine that low? How come it's not one of these lows back here? Well, you have to, it comes back to fractal geometry. You have to break down those fractals. You have to see the impulse moves, the individual impulse moves as individual fractals. So you're always going to draw your retracement from those impulse moves. We can go back to here. Now, yeah, I can draw that from that low to that high, and that's definitely a zone. If it were to overrun that zone, we would look for that. However, it didn't. But before we get to that point, you need to see these smaller zones in here. Okay, see how it bottomed right in there? Right? That would be your first impulse move, so that would be our zone. Here's the next impulse move up. See, that creates the zone. That was a strong one. It barely got down to the zone. So you can start to imagine how we can take advantage of that as traders. Here's the next one. Right there. Look at that. Beautiful little head and shoulder bottom right on top of the zone. So what we're doing is we're taking those, we're not drawing that retracement until we get the impulse move. And here's the last impulse move up, which gave us that zone right there that happened to line up so nicely. There it is. So there's very definitely a reason why we draw those retracements from where we do. And this all typifies scalability in the markets, how markets typify fractal geometry. Here's another one. Look at that. And there's the ABC that's so familiar. So it drops right down to that 618. And, you can go on and see how predictable these little zones are. Absolutely. It demonstrates how markets typify fractal geometry. There's a nice double bottom on the 15-minute chart there also. So without a doubt, we're demonstrating to you that market movement, not all that complicated. Very definitely, it follows, very definitely it typifies fractal geometry. The trick is going to be stepping up and taking a buy signal here when all the news is bad, or certainly right here. Keep in mind, this is a 15-minute chart. We pop out to that 4-hour chart, and again you can see it's the same patterns over and over again. We saw those smaller ones here in scale, and how those smaller ones are actually a harbinger of the larger ones, because when that larger move does in fact retrace, it comes in at a very predictable level. At the very least, it doesn't close below there twice, so that means hang on, right? If anything, this retracement replicated itself here. So once again, just great demonstrations of how markets typify fractal geometry. And remember, The concepts that we just demonstrated are at the heart of what we teach at Trading University.